Are you ready?
Ready.
All right, let's go. Kevin here, top 1 financial advisor and best-selling author. We are here to talk about the stock market. Today, we need to talk about tomorrow's inflation numbers and what they mean for the stock market and what they could mean for the economy, and obviously what we should do as investors and what are the things that are going to be around the corner. So let's first state the obvious. Now, today is Thursday, June 9th. The numbers come out tomorrow for inflation on Friday, June 10th. It comes out before the market opens. So before 9:30, everybody's going to be talking about what the new inflation number is and what it means. So I'm going to tell you right now what you might want to expect and what the possibilities are and what you want to have in mind as you are considering perhaps changing around your investments and then really asking some tough questions of yourself and your portfolio over the next several weeks, because it is going to be interesting. Okay, so economists right now are expecting the year-over-year inflation number, so June 2021 to June 2022, to be about 8.3%. Now, tomorrow morning, if we find out that it is 8.3% or that it is lower than 8.3%, the expectation here is that, yes, the actions of the Federal Reserve are working. Interest rates being increased steadily are helping the economy to cool down a little bit, to stop prices rising at such an extreme rate and help cool the economy and just get things back to a normal level. The Federal Reserve, their target rate every year is 2%. So we are far and away not where we're supposed to be from an inflation metric. So if rates are 8.3 or lower, that should be seen as a good thing, that the Federal Reserve is doing its job and that there is an end to this inflation madness for everybody. So that's the expectation. Okay, that is, if it is 8.3 or lower, that will be seen as a good thing. If it is higher and things are not improving and inflation is steady, then that is going to put, the expectation rather, is that is going to put a real damper on the market for a few reasons. Number one, is showing that the Fed may have to be even more aggressive, and there's a balancing act that the Fed has to play to not push the entire economy into recession. But also, I can almost guarantee you that if we don't see lower numbers for inflation tomorrow, then you're going to hear a lot about what is called stagflation, and that is stagnation and inflation, and you just mash those two terms together, and we'll talk a little bit about that as well. And that is a serious concern. It happened in the late 1970s and 1980s, and from that point in time, there is only one way to solve stagflation, and that is recession, which is not what anyone wants to hear. So hopefully for everybody, inflation numbers will go down. We can just slowly raise interest rates and we'll be fine. But let's talk about what stagflation is and what the concerns there are and why that's a bad thing. So normally the economy works, and I know the economy and economics can be complex, but essentially we have highs and lows, right? When the economy is low and things are looking bad, then the Federal Reserve cuts interest rates and expects and really incentivizes people to go and spend more money. It's like, hey, your loan on your home is cheaper. It is cheaper to go borrow money and expand your business. Go out there and spend. You're not making money in your bank account. Go out there and spend. That's what they do, as we saw in 2008, as we saw during the coronavirus, when at the height of the coronavirus, rather in 2020. They'll lower rates, get people out there. Then you have the opposite situation where everybody's out there spending and say, hey, slow down. Let's raise rates and slow people down. Now you're getting paid more to put your money in savings. Now you are, not as incentivized as you previously were to go out and buy a house or expand your business and do things like that. And they're really trying to, again, keep that balancing act from being not too low and not too high. So right now we're in the too high sector. We're in that inflation sector. They're trying to raise rates to discourage people and businesses from doing a little too much and spending a little too much. Here's a part of the problem. It is not that, yes, there's too many dollars chasing too few goods, but the supply chain issue is a big thing, and that is still due to coronavirus, which the Federal Reserve has zero control over. And then, just like we saw in the 1970s, we're also going through an oil problem due to Russia and Ukraine, which is also not in the control of the Federal Reserve at all. For example, China has a zero COVID policy, meaning one person got COVID, we shutting the whole thing down. The town, the county, whatever it is you want to call it, which makes it really difficult for companies that have major manufacturing operations in China to continue to produce goods. So you have one person sick, your entire Nike plant is down, your entire Apple factory is down, your entire Tesla factory is down, which means that there are less of those things produced, and people here and across the world saying, look, instead of having enough cars for everybody, enough chips, enough shoes, then now we have to outbid each other and those costs go up. Regardless of what the Federal Reserve does, as long as that's a policy in China, which we cannot change, that's going to be an issue. The supply chain is going to be a problem. The way that you can solve supply chain is by building more factories in other places. Perhaps you can do it in Mexico, perhaps you can do it in the middle of Iowa, perhaps you can do it in, I don't know, name wherever else in the world you can put it. But that takes time, that takes money, and it'll be years before you can smooth that out. So that's the issue. So you got supply chain, that's number one. And then what you have with Russia and Ukraine, that is two problems. While oil is the top is top of mind, Ukraine is one of the top producers of wheat and grain. And without that, that makes food prices higher, and also transportation costs higher, because we are sanctioning Russia and not taking their oil for good reason. But these are three factors, 2.5 factors, if you want to call it that way, that are hurting the economy and forcing inflation upon us. So those are some of the factors. Raising rates only solves just a small portion of that, but it's the only thing that the Federal Reserve can do. That's it. So with all that stuff out there, right, we got the inflation side, we're raising rates, trying to lower inflation, but what happens if inflation keeps going, but we're not producing as much? The economy is not growing. Remember when I gave y'all the recession definition, go back and check that video out, is that you need 2 consecutive quarters of negative GDP growth. GDP is the stuff that we produce as a country, right? What is the value of all the stuff and services that we produce? Q1 was down. It was negative 1.4%. So if we are continuing to produce less, like we're not going out there and producing that much stuff, but inflation continues to be high, that is what stagflation is. Because like, hey, we're not producing as much stuff. We weren't like in inflationary time just doing everything and spending everything. We've cut back and we've stopped, but inflation is still going higher. That is what stagflation is. That is what was a weird phenomenon in economic history between the late 1970s and late 1980s. And again, the way that they solved that was by raising interest rates to 20%. It absolutely crashed the economy and ended up in a recession. We came out of the recession, and in the 1990s, things were fine up till the dot-com bust, and then you saw how things went after that. So, not telling you that is exactly what's going to happen. I do not think we'll see in our lifetimes, I hope we don't, a 20% interest rate. But also for those who, may be above 40 who are watching the channel, shout out to y'all. There was a time, and I worked in the banks, this is the only reason I knew, there was a time where you would get like 15% on a savings account. Imagine that. You put your money in savings and get 15%. That was because late 70s and 80s, interest rates were so high that it really forced people to say, hey, look, I'm putting this money in savings. This is an almost guaranteed thing for me where I'm getting 20% a year, FDIC insured, meaning this bank go down, I'm still getting my money out, right? So that is the interesting case there. So you're gonna hear a lot about stagflation if the numbers remain, or even worse, we raise rates and inflation is still persistent and it still goes higher. That is going to be the biggest concern. What many are saying as to why stagflation is such a weird thing is because it starts to be somewhat of a self-fulfilling prophecy, meaning that if, let's play this out. If we continue to see higher inflation, let's say I own a business, right? I keep seeing higher inflation. I'm going to expect higher inflation. I'm already fearful of a recession. So what am I going to do? I'm going to cut back. I may have to lay off some people. I may have to say, look, I need to batten down the hatches and just protect myself from what I think could happen. What happens if I do that? Well, if I start to cut staff and I start to hoard money and just start saving and protecting myself, and I start to produce less, then that's less supply. If I don't have enough supply, if we as a country don't have enough supply, then we're going to go right back into an even higher inflationary place, right? So like if for example, let's say I own I'm trying to think of a business here. Let's say if I own a trucking company and I see inflation's going higher, it's really expensive for me to fuel my truck, and I'm looking at tomorrow's inflation number and it's still high, I'm gonna say, look, hey, You sit at home, we're gonna stop two routes, and we're not going to ship because I think a recession is coming. I want to save my money. I want to be protected in case this happens. Well, those two routes, without being out there and without being out in the economy and shipping supply and helping that's less supply, which means the money that's still out there, now we have to fight over even less stuff, and inflation continues to go even higher. That is the concern, and that is the weird case for how stagflation exists and why it is so persistent and why it is so hard to fix. We can fix inflation. We hope. We're going to find out tomorrow. But stagflation is even harder. And again, you can go back and there was a great podcast from the New York Times about a month and a half ago about Peter Volcker. He was the guy, he was the Fed chair. I think it was it's like 1978 or so when he took over. And he was there up until almost the 90s. But he was the one that engineered this whole interest rate thing, and he was the one that got us out of that high inflation time, and had to hurt the economy to get us on track for the 90s and the 2000s, and really set us up from an economic perspective and gave us a playbook to survive times like this, or at least what we expect to be similar to this. So there's a lot riding on tomorrow's number. Now, you may be thinking, after all this economic stuff you done told us, so what should I do as an investor? Now, for me, tomorrow is Friday, so I'm going to do what I always do. Tonight, I'm going to sit down and see what stocks I like, what I'm going to buy, and I'm going to go and buy regardless of what the numbers are. I usually try to get up and buy whatever I'm buying within that first hour or so in the market. There's no reason as to why. I just do it. It's just my habit. So we'll see there what I'm going to continue to pick up. However, you as an investor, you do want to have a defensive and dividend point of view. Okay, because while I am obviously a long-term investor, right? I want to get what I think is going to do well now and for the next 10 or 15 years, right? We can't always see that far into the future, but it is something that I do want to have on my mind. However, in the meantime, you can have the perfect investment. Like, you could have gotten Amazon in the 90s, right? But could you have survived until today? Could you have survived until it hit that first 1,000? It's hard to say when you're in the middle of it, right? And the stock market's already down, with the exception of today. Yesterday was down 12% for the year. So it's hard because other companies are down 40% and 50%. Or in the case of, some of these streaming companies, or even like a Zoom or Netflix, down 70 or 80%. So it is very difficult to stick with long-term only. That does not mean get rid of it, but it does mean, let me offset this and let me get something that can work right now. So pay attention to those dividend stocks. Coca-Cola is just one of those. Pay attention to those insurance companies if you can. If you want to go into oil, those are easy picks left and right. They are there. I got my own stance on it, and that's just me, right? We got different goals and different things, so they are out there. And then you've got your diamonds in the rough, like IBM, that are somehow still effective, and others. So there are places to go to, but playing defense is important. I gave out 5 stocks yesterday. 2 days ago, for those in the membership group. So that video is out there. I'm also going to give our members a special video later today on which stocks I'm buying. I'll probably sit down and record that right after this, and give y'all what I'm looking at and how and why. So pay attention to all that stuff. But for me, this is a time to play defense regardless of what's going to happen tomorrow. It's a time to play defense. It's a time to at least, if nothing else, let me just collect this dividend check, because it's going to be rough, right? If that's the case. And because I can't predict the future, I can't predict tomorrow, I want to start to position my portfolio today. You really want to be right in the middle, where if we go into recession, if we go into stagflation, if inflation continues, the company that I have is going to be okay. And those have been the ones that we've mentioned earlier. So perhaps not necessarily a target per se in retail, but Dollar General, right, was one of those companies that was been doing fine this whole time. Insurance, the companies and the stocks that are still going to be here regardless, and they're going to be able to offset a lot of that. Those are going to be the ones right now to continue to sustain some level of value. So you want to add those to your list. If y'all want to learn more about what areas these companies are going to be in, and what area, and kind of make another short list, y'all know what to do. Let me know in the comments and we can do that. Okay, so that's what you need to know for tomorrow's inflation number. Some people are going to be watching this on Friday and Friday during the day, so y'all get the point. And we'll find out what the numbers are at that point in time and watch how the market moves. The last thing I will tell you about this is, remember, we have a 3-layer cake of stuff that we have to go through over the next several weeks. I think it's about 3, maybe 3.5 weeks. So tomorrow starts the cake. That's going to be the inflation numbers. The market is going to react. Then we are going to hear from the Fed and how they're going to raise rates or react to whatever these numbers are going to be. I don't have the date for that yet. And then we go right back into earnings seasons for Q2 of 2022. And some companies like Target have already lowered their revenue guidance and say, look, we're not going to make that much money. Okay, we're not going to make what we used to make, even though they did increase their dividend. So those things are out there. Those things are out there. It is going to be a very interesting time. There will be opportunities. There will be, I'm going to tell you right now, there are opportunities. There are some companies that you like and they're a little expensive. They might come down a little bit. Okay, so there are opportunities. It could get a little rocky. I don't know in which direction things are going to go, but this is a time to really evaluate yourself and how you react to risk, evaluate your portfolio, and at least have some, I'm not saying all, have some of your portfolio in the right spots should things not go the way that we expect or go the way we want them to, because we want the economy to grow, we want the stock market to grow. But in case it doesn't, you want to be able to say, I have 1, 2, 3, 4 stocks that are going to help me. They're going to reduce these losses in time like this. All right, that's it for me. I did this all in one take, which is surprising because a lot of times I mess up, so that's fun. All right, let me know what you think in the comments below. I'll talk to you later. Bye.